Let's talk to the Chief Executive Officer of Major Drilling Group International. It's a major driller for mining companies on the continent. It saw strong sales growth in its fiscal third quarter. Although there could be some economic wins for the company, tariffs are not likely to be one of them. Joining me now is Denis Larocque, President and CEO of Major Drilling. Denis, thanks a lot for joining us. It was a busy quarter and there were numerous moving parts. Revenue rose by 21%, but that was affected by a big acquisition the company made. So break down the revenue. What was the organic revenue, excluding the acquisition?
Yeah, excluding acquisition, revenue was down about 3%, but really in line with what we've seen in the industry. But revenue overall is up 21% following our acquisition of Explomin.
This is typically the weakest of the four quarters for not only your company, but for the industry, correct?
Yeah, basically what we see is there's a lot of shutdowns around Christmas season. Mining companies, especially the more greenfield exploration it is, the more likely you see shutdown for Christmas and come back in January at some point. And so this year was no different, although we did see slowdown for Christmas happening earlier, and then mobilization coming out in January a bit later than last year, which is the reason why our revenue was down a bit.
Drilling in the oil and gas industry can often be slowed down by soft, wet, mushy conditions. Is that the case in your industry as well?
Yeah, but we do have a very good distribution. We operate in 20 countries around the world, so Canada is not is only a small part, about 10 to 15% of our operation. So the impact of that is not as much, but we do get affected by seasonal. They're just different in different jurisdictions. For example, in Latin America, where we operate in altitude, we do get affected differently than we do in North America. But the weather always plays. We do operate in weather conditions, so the weather always play a little bit of has a little bit of an impact. But it wasn't that much this quarter.
Okay, the company is telling its shareholders that there are positive indications with respect to future plans of your customers for exploration spending. Some of your larger customers have outlined their exploration budgets. What are they saying?
Yeah, basically, junior revenue was down a bit this quarter, but seniors are really picking up steam. And in fact, they just came out with their budgets for 2025, for calendar 2025 for the most part. And early indication is that those budgets could be up between 15 to 20%, which is quite significant. And really in line with what they need to do. On a lot of the commodities, including gold and copper, the reserves are coming down. And in the case of copper, we're not going to be able to meet the demand that's coming over the next few years. And there's lots of talks these days about critical minerals, and copper is certainly in there, and there's not enough out there to fit with the demand. So there needs to be a lot of exploration done to find the next deposits on gold and copper, and that's what we're seeing this year. We're starting to see really a pickup from seniors, basically in our industry, exploration is a 5-7 year exercise before you can start to bring mines into production. So we're just at the beginning of this upcycle.
How does your revenue break down between seniors and juniors? Seniors are in many cases trying to expand the dimensions of existing ore bodies, I would think. Juniors are often out in the greenfield drilling on properties they think are promising, and they are likely, as you've indicated, years away from finding, if they ever find, a mineable resource. What's the breakdown between seniors and juniors?
Well, our breakdown is a bit different than the industry. This quarter, 94% of our revenue came from seniors and intermediates, and that's because our company is geared toward higher end services, what we call specialized drilling, where a lot more expertise is required, deep hole, high altitude, remote locations, and all kinds of things like that. But that percentage is certainly higher on the seniors than it's ever been, because juniors have been struggling to raise funds. But I mean, the good news is that we've got a good base of business, stable base of business with our senior customers, and the greenfield, as you mentioned, coming from juniors is ahead of us. And our senior customers are basically taking some of that on their own and doing their expansion. So again, things are looking very positive for the future when you look at the whole make of everything that's ahead of us on commodities.
Like all Canadian CEOs these days, you were asked on the conference call about the company's exposure to tariffs in the United States, and it's fairly modest, I gather. First of all, you're a provider of services. You don't sell physical products to buyers in the United States. And as you've just said, you operate in about 20 different countries around the world. But there's at least some modest, I guess, indirect impact. Why don't you answer that question for our viewers?
Yeah, there certainly will be an impact, just like there will be an impact on any business that operates. Any business, so you buy products to run your business, so any business is going to get impacted. In our case, like you said, we're in the service business, much lower impact. U.S. is a small part of what we do, given we operate in 20 countries. And then we are one of the largest, if not the largest, in terms of number of rigs in the world, and therefore, and because of our geographic diversification, we're able to source from different sources, which allows us to manage the tariffs, depending, and maybe just change where we get our products, whereas a lot of our competitors might just be lined up with like one country. So we do have a lot of flexibility within our operation to relatively minimize and really minimize the impact of the tariffs.
Okay, your industry is one in which accidents and injuries are certainly possible, and yet the company achieved its best ever safety record in the most recent quarter. Congratulations, first of all. And let's finish with how the company accomplishes that. You've got team members, of course, dedicated to that focus. How did they succeed?
Yeah, it is unbelievable how far our industry and our company really has come. I've been with the company for 30 years, and I'll tell you, 20 years ago, their drill sites looked nothing like they look today in terms of everything that we have at the drill site, and also the culture. A driller in the past, a picture of a driller would be, and if you go look in data, in the past, a picture of a driller would have a ball cap and sneakers, and then these days they've got gloves, they've got safety glasses, hard hats, boots, and then also the culture of taking the time to do the job. So that culture has brought down our stats by multiples, and again, it just continues. And this quarter was just a demonstration of that continuing improvement. And I mean, we're quite happy, and we won the Safe Day Every Day award from the PDAC and the Association of Mineral Exploration for this year, and we're quite happy about that.
Denis, thank you very much for joining us today. Denis Larocque, President and CEO at Major Drilling Group International. Most of the world's large gold mining companies recently have reported year-end results, and that means fresh data is now available on how much gold the biggest miners are producing. Here's the latest scorecard, and two of the top three names are very well known to viewers and Canadian investors. You'll see number one is Newmont, also a very familiar name, 6.7 million ounces produced in 2024. The next two, Barrick and Agnico Eagle, two flagships of the Canadian industry, producing 3.9 million in the case of Barrick and 3.5 million in the case of Agnico Eagle. Polyus is perhaps a lesser-known name on this list. It's a big Russian company. It trades in London and in Moscow, and Anglo Gold is also a familiar name, 2.6 million ounces there. The big uptick in Newmont's production came by way of the takeover of Newcrest Mining in Australia. Barrick's lead over Agnico Eagle narrowed after production fell at Barrick due to operational setbacks, and it's possible that in 2025, Agnico Eagle could overtake Barrick if Barrick's mine complex in Mali remains closed. Barrick and the government of Mali are in the midst of a dispute